Hey, good morning, everybody. Welcome to the Ankerstar Wealth Morning Show. I have three exciting topics for you today, and it's not exciting in the market after all the bloodshed from yesterday. But yes, the market does go down on occasions, and of course, today it started in that direction as well. But we'll see. It's kind of trending better. The market's only been open in 16 minutes, if you will. But Mike's going to cover that first. Some of the sell-off yesterday. Including the largest in history is kind of a headline we saw, loss in market cap from Nvidia, almost down 10% yesterday. So Michael talked about that and kind of what that means for the market going forward. Also, Mike's going to talk about an article he found about 40% of people are behind on their retirement planning, which, I kind of agree with Mike. We're talking ahead of the show. That's almost like good news. That means what, 60% are on track? Right. So anyhow, but Michael talk about the 40% that aren't and what that article has to tell us. And lastly, if you've noticed in your accounts, if you're with us, we loaded up heavy into CDs when they were paying that 5.5% and above. Well, a lot of those are maturing. A lot of those are just getting called away a little bit early. So I'm going to show you what kind of options we have with the CD rates that are going on, and to talk about how interest rates, even though the Fed hasn't cut rates, the market has priced a lot of that in with how the rates are moving out there. But before we begin, a reminder, this is a financial education presentation. You have to do your own due diligence for acting upon anything you hear in this presentation. There's more disclosure information available at ankerstarwealth.com, and the opinions expressed are Mike and mine alone. Let's start with Mike and what's going on in the markets.
All right. Yes, the Dow, which only has 30 stocks, is in the green by a little bit. Really, the S&P is just down 0.08%, and the Nasdaq's down 0.36%. And it was down quite a bit. Oh, I say quite a bit. It was down almost 1% earlier. So it's come off those lows. And compared to yesterday, the Nasdaq was down 3%. The S&P was down 2%. So those were big drops. In fact, I want to show you the NASDAQ graph of the last, I'm going to pull up just the last 3 months, because at the beginning of August, we had, if you remember, we hit a July high, and then we sold off into the beginning of August, and that was a big drop. So yesterday's drop, when you look at this graph, is not nearly as bad. So I just want to kind of point that out for relative. It is not like, whoa, as bad as it was back in August. And look how that came back. Now, does the NASDAQ come back automatically? We don't know that. But I do want to go back and look at last year, just real briefly. And if I'll zoom in a little bit so you can see 2023. So 2023, you can see the market went up, and then it sold off in October, and then it went up the rest of the way. Seeing similar patterns. We've had these volatile sell-offs here. Yesterday, largely caused by Jensen himself. No, I'm just kidding. Maybe that'll get him to friend me. No, it was Nvidia sold off a record, and you gotta love these headlines, a record $279 billion. So that's how much their market cap went down yesterday when their stock sold off 9.5%. $279 billion. I think there was, last time I looked, there was only maybe 20 companies that were bigger than 500 billion. So I mean, like Intel is worth like 80 or 90 billion. Like they dropped 3 Intels yesterday. Just to give you a perspective. Fortunately, it is at most is like a 5% holding in one of our model portfolios. But even then, it's painful. I don't want to see that thing drop, and it dropped in my account just like it did in yours. Today, Nvidia is just barely down 0.33%. I'm hoping for a rebound, but I'm showing a 5-day graph so you can just see kind of how ugly this looks in the last 5 days. It was in the 122 when they came out with their earnings last week, where their earnings were phenomenal, but they still sold off 3 or 4%. Maybe it was a delayed hit. Actually, it didn't sell off because of earnings. It sold off because the concerns with the economy and the concerns that maybe AI isn't as big as everybody thinks. In fact, in this article, there was a little bit about that that's the concern, that cautious about emerging AI technology that has fueled much of this year's stock market gains. And if there's anybody that has benefited from AI, it is Nvidia. I mean, they are so far the biggest beneficiary, the stock that's moved the most market cap wise. ChatGPT, OpenAI is not a public company. I mean, that's going to be a big one when they IPO, but even then, it won't still be close to as big as Nvidia is. So sell-off is painful. Nvidia hit a high earlier this year of $140 a share, and I had people asking me, why am I not in Nvidia directly? They did have exposure to it through JTAC, but they were asking when it was at 140, why am I not in there? When it sold off 20%, got down below 112, we started adding it to our models. Guess what? It's still on sale at $107. Nvidia did not come out with bad news yesterday that would cause this. It's just that concern. So anyways, we'll see what happens with it the rest of the week. The big numbers affecting the markets coming out later this week will be the unemployment on Friday. The other article I saw that was interesting, I saw this headline, 40% of workers are behind. And, it's trying to get your attention, which it did. It got my attention because I was like, 60% of workers are on schedule. That's good news because it doesn't feel like it. A lot of times, and it's really that, what's retirement planning? Like even Steve and I were talking about financial security. Are you financially secure when you have 5 million in your bank account, or are you financially secure when you have a good job and 50 grand in there in your retirement and a plan to get to 5 million? It's all kind of that perspective. So let me scroll down here because what I liked about this is it went by age demographic. So this is what I really like. 37% of baby boomers between ages 60 and 78 said they felt behind. Well, guess what? If they feel behind, they are in the moment, and they are like, they can see the light at the end of the tunnel, and they know whether they've got enough or not. And then we get to 26% of us Gen Xers, 13% of the millennials, and guess what? Only 5% of the Gen Zers feel like they're not behind, or they're not regretting saving, because they're not saving anything yet, right? They're probably like, I'll be fine for the future. So 95% of them said, I'm good. And that kind of, when I think about those numbers, that makes sense. The reasons why people are behind in planning and savings, largely due to debt, insufficient income, or getting a late start. So I guess if you're a Gen Z, guess you haven't even started yet, but you're not late, and your income's going to go up, and hopefully you're not in a ton of debt. But as you get older, these things all occur. In this poll, you always got to look at numbers. Did they poll 20 people to get this? They polled 6,600 people. So that seems like a statistically significant number. But I will say that if you're listening to this and you're like, I don't feel like I'm set on my retirement planning, and you're not already a client or you're thinking about it, talk to us. That's what we want to help you feel, is that you have a plan and you know where you're going, and you can get there. It's a lot easier when you have a plan than it is just randomly trying to figure it out. So what do you think about that, Steve? You agree with those numbers?
Well, I'm a little bit surprised by those numbers. And again, the tapering numbers you said there about feel that they're less behind is because they're not really thinking about it, right? This one of the best things about this profession is it's a lifelong passion to have, get people to have a plan, get people to feel comfortably financially secure, whatever that means for them, and then also get them to invest, which isn't right. Not everybody fully understands it. I hear term, you have a big sell-off like yesterday, and it's just like, well, some people don't like that. It's like, well, I think we all would agree, if you step back and zoom out, that yes, aggressive investing in tech is the way to build your wealth, but that doesn't mean there aren't going to be down days. And those down days can be kind of ugly, but that's all part of the investing experience to be able to get to the riches. If you don't want to do that, we understand, but we need to help you understand that so you can dial down your risk, so you can go into things that only go up on a daily basis. And that's CDs, which is what I'm going to talk about. I'm going to share out my screen here. And there's no right or wrong to investing. It's just simply that this is, what if you have a lower risk tolerance where you don't enjoy the roller coaster at all, or you don't ever want to see your balance go down, then you kind of have to get into this heavy fixed income or risk-free rate, if you will, which is what I want to talk about here. So if you look at that top two lines, and it's a little bit of an eye chart there, but the third column over is the, where you see 4.65. That's the coupon rate on that CD. And you can see these are 1-year CDs. There are some above that or that are shorter or from banks you've never heard of, which you need to stay clear of. That's my opinion. But you get into Bank of America, JP Morgan Chase, that is the core bread and butter, if you will, of big banking that you can trust. The reason I bring this up is 4.65 is a lot different than the 5.7 that you saw at the kind of the prime of the interest rates going up there. So for those of you that have been in it for a year or 6 months, or you're having CDs mature a lot, we see them every week. There's a whole handful that mature. So what to do with your money? Well, if you're a CD only investor, then you simply stay on your game plan and you roll right back into CDs, just realizing that, okay, sometimes the rates go up, sometimes the rates go down. 4.65 doesn't seem good when you compare it to 5.7, but it seems fantastic to 0, which is where, 0.25%, which is what you got for like a decade, right? When interest rates are at 0. And we'll see where the market goes. But still, 4.65, that's risk-free. It does go up on a daily basis, basically a cruise. And then we have rates, are going to come down, which means your CD is going to be worth more if you choose to sell it, even though we're going to hold these to maturity, as a whole. If you are looking for the one that doesn't go down, you've heard us talk about this in our investing is not USFR, that just tracks treasuries. I'll bring up the chart here. The chart looks like a sawtooth just because that's the way it gives distributions out every month. So when this populates, it looks like, okay, that's a sawtooth. Well, not really. These are monthly distributions. So the amount that it drops is the amount of cash that goes into your bank. And when you look off to the right, we're looking at, 50, this whole chart's from 50-20 to 50-50, meaning $50.20 to $50.50. So you can see it just kind of chugs along out there. So it's another alternative when you're like, well, how much does it make? How much does it kick off? Down here to the right, it's 5.4%. That lags slightly. That takes the whole year. That's cheating a little bit, right? Because it's going to get smaller. So I would say it's really more like 5% if you would carry that forward. So that's just another option for you instead of locking up into a CD. So these things are out there. When the market's screaming higher, you feel like you're being left behind. But when the market's selling off or faced increased volatility due to the election, these things can be the security blanket that you need, whether it's all of your portfolio or just a large portion of your portfolio. So now, just wanted to get into that. Mike, any thoughts on that before we close there?
Just one question that I get from some clients, and I'll ask you it, but I know the answer. But sometimes when something goes ex-dividend, so it does that drop. I've had people ask me the questions like, "Oh, my VCLT or USFR is down. I'm losing money. It went down," and I'm like, give it a couple days. But go ahead, explain what happens.
Well, let me share that back out. You're right. So if let's go here to this most recent one for USFR see if I can get my cursor to go to the actual date. Look there, here we go. So August 26th, a dividend paid out from 40, let's say it went from 50.47 all the way down to 50.23. Quick math tells me that paid what, 24 cents. So 24 cents hit your bank account or hit your brokerage account. But of course, the corresponding thing dropped. So it's really completely right. So if you were to sell the day after it goes ex-dividend, or when you realize the dividend, you're actually seeing you would be selling at a lower price for the amount of the dividend. If there was a trading strategy around this, where you would simply hold something and wait for it to distribute and then sell, trust me, everyone would be doing that. There's not. There's really break even. So it really doesn't make any sense to sell something just because it went ex-dividend, or if you're hanging out there for that one last dividend payment. If you're going to sell anyway, that's a separate argument. But just because something went ex-dividend does not make it now all of a sudden a sell, because you're selling it for less whatever the dividend was. Does that answer your question there?
Yeah, it takes a day or two for that dividend to show up. So when you look at your total balance of your account, you'll be like, it's down $50 or $100. Give it a day or two, it'll be there, and then you'll be back to where you think you should be.
Yeah. So, I mean, ex-dividend date down here, and then the dividend amount. I said, what, 24 cents? It's 23 cents, if you will. And then, yeah, it's right, ex-div, and then there's a couple days where it pays out. Now, if you hold it on the ex-div date and then sell it, even though you no longer have that holding, that dividend will still hit your account.
Okay.
So even though you sold it, so it'll be a couple days later. You're right. So, all right, that is good stuff. Thanks again, Mike, for your time this morning. And again, when markets turn to red, that's when you find out how people truly understand the whole investing process, not just when the good days are here, but also handling bad days as well. So again, like Mike said, if you have any questions or you don't feel like you're on track, go ahead and reach out to one of us. With that, we will talk to you guys tomorrow. You guys have a good one. Bye.